Today, I'll be breaking down Meta's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Meta's growth trajectory is truly remarkable. Over the past decade, the company has achieved an astounding 12.8% surge in revenue, boasting an extraordinary annual average growth rate of 32.1%. When we shift our focus to net income growth, Meta has consistently delivered an impressive 34.9% annual growth rate, resulting in a staggering total increase of 1,894.2%. Similarly, earnings per share have shown remarkable growth, with an overall increase of 1,786.7%, translating to an impressive average annual growth rate of 34.1%. Wrapping up this dimension, free cash flows have seen a substantial total growth of 1,111.4%, averaging a solid 28.3% per year. Meta's performance in the growth dimension deserves a perfect score of 5. Now, let's shift gears to profitability dimension. With a decade-long average gross margin of 81.8%, the current 79% margin, while slightly lower, remains exceptional. The operating margin, currently at 29%, also shows robust operational efficiency against a 10-year average of 37.7%. Free cash flow margin has averaged 21.3% over the last decade, standing firm at 18.6% today. Lastly, Meta's return on invested capital, with a 10-year average of 34.9%, is still impressive at 27%. These figures underscore Meta's solid profitability and financial health. Moving on to the solvency dimension. Meta's quick ratio has maintained a robust 10-year average of 7.47. While the current value has dipped to 2.57, there is no cause for concern as this figure remains solid and indicates a healthy ability to cover short-term obligations. An uptick in the debt-to-equity ratio from 0.07 to 0.25 remains well within a secure range, signaling a low reliance on debt financing. The negative net debt-to-EBITDA ratio is particularly telling, as it reflects Meta's advantageous position of holding more cash reserves than debt. Furthermore, Meta's capacity to clear its debt using just 1.53 years of free cash flow, though higher than the decade's average of 0.67, is a testament to its fiscal prudence. A perfect 5 for solvency dimension. Now the important fourth dimension, valuation. Meta's excellence as a business doesn't necessarily translate into a stock to buy. Great companies often come with high price tags in the stock market. Let's see if that's the case with Meta. The enterprise value to sales reveals a 10-year average of 12.6x, while the current multiple stands at 8x, implying a potential undervaluation. Turning our attention to the enterprise value to EBITDA multiple, we observe that it averaged 27x over the past decade, with the current multiple declining to 21.5x, again suggesting a potential undervaluation. In terms of the price to free cash flow metric, the 10-year average of 72x exceeds the current multiple of 43.8x, which also signals that Meta's stock may be undervalued. Lastly, the current value and the 10-year average of the price-to-earnings ratio are 34.9x and 52.7x, respectively. This further implies that Meta is currently undervalued. Now, let's explore the fifth and final dimension, which is shareholders' return. Given that Meta does not pay a dividend, the metrics dividend growth, dividend yield, and payout ratio are all naturally rated at 1. An important metric to consider is the number of shares outstanding, which indicates that Meta has increased the total amount of shares outstanding by 4.5%. This is not a cause for concern, primarily because since 2018, Meta has consistently undertaken shares buybacks at an annual rate of approximately 2%, which is absolutely great and makes me optimistic about the future shareholders' returns. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.8. Now let's move on to Meta's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Meta's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Meta's stock fair value at $607, almost 55% above the current stock price, which indicates that the stock is undervalued. The bull case prices Meta's stock fair value at $840, more than 100% above the current stock price. Finally, the bear case prices Meta's stock fair value at $396. Even the bear case scenario signals that Meta's stock is undervalued. In summary, Meta receives a strong 5D rating of 3.8, and when we consider its weighted average price target of $611, it suggests a substantial 56% undervaluation. To bring it all together, my final conclusion is, next round, Analysis 2.0. Meta, in addition to being an exceptional company, appears to be trading at an undervalued price, which is what every investor wants. Great businesses at great prices. Consequently, I will proceed with the in-depth Analysis 2.0 to ensure that this first assessment of Meta's business and valuation is accurate. Don't forget to subscribe to my channel and stay tuned for upcoming analyses.